Today, we're diving into a huge financial moment. What happens when you hit $250,000 in your investment portfolio? Now, if you're already there, or even if you're on your way, seriously, congratulations. But here's the thing you need to know. The game is about to change completely.
First off, just take a second and look at that number. Seriously, this isn't just some balance in an account anymore. Nope. This is the result of years of discipline, of saving when it was hard, of making smart calls. You've really earned this.
Hitting this number is a real transition point. You're officially moving out of that pure accumulation phase, where every single dollar was a struggle to save, and you're stepping into a totally brand new stage of your financial life.
And that right there is the real pivot. The habits that got you here, like just saving consistently and putting money in a broad index fund, they're fantastic, don't get me wrong, but they're not enough anymore. To get to $1 million and then beyond, you actually need a new playbook. So, what's in it?
Well, it all starts with a fundamental shift in how you see yourself and how you see your money. You're not just a saver anymore, just putting money away for some far-off future. You are now an owner of a significant income-producing asset.
Let's look at the new math you're working with, because this is where it gets really fun. As this table shows, even with a pretty conservative 3.5% yield, that $250,000 is generating about $8,700 a year. That's almost $730 every single month. This isn't just some small bonus. That's a car payment. That's your utility bills. It's a huge chunk of your groceries. It's a real paycheck coming from your investments.
And this gets right to the heart of that mindset shift. The saver, over there on the left, their whole world is about contributions, just trying to grow that balance. But the owner? Oh, the owner on the right is playing a different game. They're focused on efficiency, on managing an asset, on owning an actual income stream. Your main job is no longer just adding more money. It's making the money you have work as hard and as smart as it possibly can. So let's talk about that new job description. From this point on, your number one role is to protect what you've built and squeeze every last drop of efficiency out of it. And you know what the two biggest drags on that efficiency are? Yep, taxes and fees.
The very first tool in your new playbook is something called asset location. Now, this sounds kind of technical, but it's an incredibly powerful concept that's actually pretty simple. It's not just about what you own, it's about where you own it. Just putting the right investments in the right accounts can literally save you thousands of dollars in taxes year after year.
So here's how that works in the real world. As you can see in the table, you want to put investments that kick off a lot of taxable income, think bonds or high-dividend stocks, inside your tax-protected accounts, like your IRA or 401k. That shields all that income from taxes. Meanwhile, your long-term growth stuff, like your broad stock index funds, they're actually better off in a standard taxable brokerage account. Why? Because you'll get those much lower long-term capital gains tax rates when you finally decide to sell, way down the road.
Okay, let's talk about the second threat, fees. A tiny-sounding 1% annual management fee on a portfolio this size will cost you $2,500 a year. Every year. Just look at that bar chart. That's almost 30% of your annual investment income just vanishing. Poof, gone. This means you have a new hobby. You have to become a fee detective. Your primary goal here is to just slash these costs mercilessly. Stick with low-cost index funds or ETFs, and really, you should be aiming for expense ratios well under 0.2%. Seriously, minimizing fees is the easiest, most guaranteed way to boost your long-term returns. It's the lowest hanging fruit you can possibly pick. Now, with a portfolio of this size, market volatility just feels different. It hits different. A bad month could mean watching your account drop by like $15,000, and that can trigger some serious panic and lead to some really terrible decisions. To stop that from happening, you need a clear, pre-written plan for managing risk.
And that plan starts with your asset allocation. A really common, sensible mix for this stage is something like what you see here. About 70% in stocks for that long-term growth, and 30% in bonds for stability. Now, the bonds aren't going to grow as fast, but they act like a shock absorber during those rough market downturns, helping you sleep at night and, most importantly, helping you stay invested.
And to keep that perfect mix, you need to rebalance, maybe once a year. It's a simple 4-step process. You check your allocation, you see if it's drifted off target, and then you sell a little bit of what's gone up, and you use that cash to buy what's gone down. It's a disciplined, automatic system that forces you to lock in some gains and buy assets when they're on sale. It's the literal definition of selling high and buying low without any emotion. Okay, let's circle back to that $700 a month your portfolio is now spitting out for you.
we need to talk about how to strategically use that new income. You've got some really powerful choices to make now. The default, and honestly, often the most powerful option, is to just automatically reinvest it. Let it ride. That just turbocharges your compounding. But if you have any high-interest debt, like credit cards, using this cash to obliterate that debt gives you a guaranteed high return on your money. And a third, really clever option, you could use that income to supplement your living expenses, which then frees up cash from your salary to max out your 401k or IRA contributions. That is a huge long-term tax win.
Reaching this $250,000 mark also unlocks a new tier of more sophisticated financial tools that, frankly, just weren't available to you before. This is where things start to get really interesting.
One of the most powerful of these is the securities-backed loan. This lets you borrow against your portfolio at a very low interest rate without having to sell anything and trigger a big tax bill. It's like having a financial passport. It gives you access to cash for a major opportunity, maybe a down payment on a property, without knocking your whole long-term plan off track.
At this stage, you also need to start practicing what's called holistic management. It's time to stop looking at your 401k, your IRA, and your brokerage account as separate little buckets of money. Instead, start seeing them as one single, unified financial engine and coordinate all your investments across all those accounts to maximize tax efficiency and overall performance. So, we've covered the mindset, the efficiency, the risk, the strategy, but the final, and I mean the absolute most important challenge, is mastering your own behavior. Because the market will test you, and your emotions are now officially your biggest enemy.
So what's the solution? You have to institutionalize your discipline, and you do this by creating a simple, one-page document, an investment policy statement. Think of it as your own personal financial constitution. It defines your allocation, your rebalancing rules, it defines everything. Then, when the markets are going crazy and you feel that urge to do something rash, you don't. You just consult your constitution.
Because this is who you are now. You're not just a saver anymore reacting to whatever the market does. You are the calm, rational board of directors for your own financial future. You make decisions based on a plan, on a protocol, not on fear or greed.
So it really all comes down to this. You have successfully built a powerful wealth-generating engine. The big question now isn't about building it anymore. It's about whether you have the discipline to steer it correctly through all the storms and all the opportunities that are waiting for you up ahead. Do you?